Hey, what's up, people? Late day video for you for all you gambling junkies. A lot of people ask me what I'm doing on certain earnings reports, whether I'm buying puts or buying calls. I think I've told you this before, and I learned it the hard way, that buying options before the earnings report is a gamble that in sometimes could be lucrative, but most of the time you're paying a lot more for those options because the volatility is so great due to the fact that the earnings are going to be released. So you need a bigger move than you would need to make money on those options. Okay? Now, what you want to do is instead of playing a stock on before the earnings come out, play that stock after the earnings comes out, because that's when the real move is going to happen. And especially if the stock reverses on earnings. How many times have we seen a stock gap up on what the headlines read as good news, and then as soon as the market opens up, it starts to tank, goes red? The chances of a stock, once it sells off its gap and goes negative, the chances of that stock actually continuing on the downtrend is about 80%. So your percentages are so much greater. So if you want to buy options, you might actually wait for the next day, the volatility comes out of the options, and try to look for a reversal on that option. And obviously if the stock is trending one direction, then play the options for some. Especially with options expiration, you're going to find some cheap options. Because if you're looking at Intel options that come out tonight, and you're thinking it's going to get hammered, so the stock's trading at $16.71. You want to buy a $16 put for 15 cents. The stock in theory has to fall $1 just to start making you some money. With the time left in the week, you'll have 3 days. So if it does fall $1, you'll probably see a 25-cent or maybe a 30-cent bid on them. So you can double your money if the stock falls a point or more. But that's a big fall for Intel. Now, obviously, if you buy the calls, let's say if you think Intel's going to blow out earnings for some reason, and you want to go buy some $17 calls, you're going to be paying 30 cents for that stock. So basically the stock has to go to $17.30 for you just to break even. So then we have to go up any penny above that, obviously start making money. Which, relatively speaking, is actually a better percentage play based on the price of the options. Basically just based on the price. I don't know what the stock's going to do. Nobody knows what the stock's going to do. But I'd rather wait till tomorrow and see how it plays out. So good luck, and if you're trying to play those out, like I said, if you're trying to play earnings, what you want to do is, if you think an earnings report's going to be good, buy some calls 3 days before the report earnings, because the real money will be making bets on the stock 3 days prior. So a stock will run to those numbers, and a lot of times when the headline comes out and it's such a great number, and the stock goes down, everyone's like, why did it go down? The numbers were so good. It's because the real money got in 3 days ahead of that, anticipating a good number. The good number comes out, and you sell on the news. That's why it pretty much explains that right there in a nutshell. All right, well, good luck to you. I'll see you guys after tomorrow. See you.